If you are 60 or older and collecting Social Security or Medicare benefits right now, I need you to stop what you are doing and stay with me for the next several minutes because 3 significant money changes are hitting seniors right now in 2026, and every single one of them directly touches money that is already yours or money you are fully entitled to claim. One of these changes can stop your monthly Social Security payment from arriving at all if you take no action. Not slow it down, stop it entirely. One of these changes can put thousands of dollars back in your pocket at tax time through a brand new deduction that most seniors have never heard of and will therefore never claim. And one of these changes sets a hard ceiling on what you will ever pay for your prescription medications for the rest of this year, but only if you understand how the program works and take the one step that actually unlocks the protection. These are not theoretical changes that might affect you someday down the road. These are real dollars with real deadlines connected directly to your monthly check, your tax refund, and your medicine cabinet, right here, right now, in 2026. And here's the part that genuinely concerns me as someone who works in this space every single day. The overwhelming majority of seniors I speak with have either heard nothing about any of these 3 changes, or they caught a headline somewhere that gave them the gist without ever explaining the one specific action that actually captures the benefit. And that distinction matters enormously. A headline does not deposit money into your account. The form does. The phone call does. Knowing the right program name and the right number to call and doing it before the deadline, that is what does it. So that is exactly what I'm going to walk you through today. All 3 changes laid out in plain English with the specific action required for each one. Not vague suggestions, not general awareness, the actual move. I am not here to scare you unnecessarily, but I am also not going to sugarcoat any of this. Because the seniors who do not hear about these changes, or who hear about them and think they can get to it later, are the same seniors who end up on the phone with Social Security trying to figure out where their payment went, or doing their taxes and realizing they missed a deduction that could have saved them over $1,000, or sitting at a pharmacy counter paying for medication that should have been covered at no cost to them months earlier. That is not going to happen to you today. Not if you stay with me through this entire video. And before we go a single step further, do me one quick favor because it genuinely matters for how this information spreads to the people who need it. Hit the like button right now. Subscribe if you have not already. It costs you nothing, and it is the only real mechanism that puts this information in front of the next senior who needs to hear it before a deadline passes them by. Now let me lay all 3 changes out for you up front so you know exactly where we are headed, and then we are going to take each one individually and go deep. The first change is happening to the payment delivery system itself. The way your Social Security benefit physically reaches you is changing by federal mandate. And if you are one of the people this change affects and you ignore it, your check can simply not show up, not arrive late, not arrive reduced, simply not arrive. The second change is a brand new deduction written directly into federal tax law. It can shield several $1,000s of your income from the IRS and send real money back to you at filing time. There is a strict income cutoff on who gets the full amount, and there is a window on when it applies that you need to know about. The third change is a legal ceiling that now exists on what you pay out of pocket for covered prescription drugs under Medicare Part D for an entire calendar year. Once you hit that ceiling, you pay nothing more for covered medications for the rest of that year. But there is a program layered underneath that can push your costs down dramatically even before you reach the ceiling, and most seniors who qualify for it never apply. 3 changes: your deposit, your refund, your prescriptions. Let us take them one at a time. But first, let me answer the question that is probably already forming in your mind, which is this. If these changes are this significant, why have I not heard about any of them? And the honest answer is the same answer that explains why I make this kind of content in the first place. These changes do not arrive as a phone call to your house. They do not show up as a notice in your mailbox that says, "Here is something that affects your money. Here is what to do about it." They show up as a line buried inside a multi-hundred-page piece of legislation, or as a policy update posted on a government website written in language that was clearly not designed for anyone to actually read and understand, or as a rule that takes effect quietly on a specific date while every other news cycle is focused elsewhere. Nobody is coming to your door to make sure you set up electronic payment in time. Nobody is calling to verify that your tax preparer knows about the new deduction. Nobody is sending you a reminder that you might qualify for a prescription drug assistance program that stacks on top of the cap. The system simply assumes you will figure all of this out on your own. And when you do not, It either keeps the money or lets the deadline pass or lets the benefit sit there unclaimed. That is not malicious. That is just how the administrative machinery of government works. And the only defense any of us has against it is knowing. So let us make absolutely sure you know. Let us start with the change that carries the most urgent timeline, because this one has a specific date attached to it, and it is not forgiving. The first change is this. The federal government is ending paper checks for Social Security and transitioning every single beneficiary to electronic payment. If you are currently receiving a paper Social Security check in the mail, what I am about to tell you is the most important thing you will hear today. The window to act voluntarily is closing. And if you do nothing and wait for it to close completely, you are looking at a real risk that your payment simply does not show up. Let me be completely clear about the legal basis for this, because this is not speculation and it is not a rumor being passed around online. This is an executive order. Executive Order 14,247, signed in March of 2025, which directs the federal government to modernize its payment systems and to eliminate paper checks for federal benefit payments. The Social Security Administration moved into implementation of that transition and set September 30th of 2025 as the initial milestone date, with the broader goal of completing the transition away from paper payments entirely by the end of 2026. In plain terms, the paper check is going away, not being phased down, not being made optional, going away. And the transition is not asking for your consent or waiting for your preference. It is moving forward on a government timetable. Now, who does this actually affect? If your Social Security already comes via direct deposit into your bank account, you can take a full breath because you are done. Nothing about your payment changes. The money arrives the same way it always has. This change has no visible impact on your day-to-day financial life. But if you are still receiving a paper check in the mail, or if you have a parent or a spouse or a neighbor who is, this is the moment that matters. Because once the paper check stops and there is no electronic destination set up to receive the payment, that money has nowhere to go. A payment with no delivery address is a payment that does not reach you. And I want you to think for a moment about who is most likely to still be receiving paper checks in 2026. It tends to be the oldest seniors, the ones who have been doing it the same way for 30 or 40 years, the ones who do not bank online, the ones who never needed to change because the check kept coming and there was no reason to think about it. Those are exactly the people who can least afford a missed or delayed payment. And those are exactly the people this change can hurt most severely if they do not hear about it in time. That is why I need you to share this part of the video specifically. If you personally are already on direct deposit, think about who in your life might not be. A parent, an aunt or uncle, an elderly neighbor, someone in your community. Share this with them today, not next week, today. So here is your action. And I want to give this to you in simple, concrete steps, because the only thing that actually fixes this is doing it, not just knowing about it. You have 2 clean paths to receive your Social Security electronically. The first path is standard direct deposit, straight into your checking or savings account. To set this up, you need 3 pieces of information: your bank account number, your bank's routing number. Both of those are printed on the bottom of any paper check from your bank, or your bank can give them to you directly at the branch or on the phone. And your own Social Security information. Once you have those 3 things, you can set up direct deposit in one of 2 ways. You can create a free My Social Security account at ssa.gov and enter your banking information directly in the system online. Or you can call Social Security at 1-800-7721-213, and a representative can take that information over the phone. Or you can walk into your local Social Security office in person. Or, here is the option many people do not think of. You can walk into your bank or credit union and ask them to help you set up direct deposit for your federal benefit. Banks do this every single day, and they know exactly what to do. Any of those 4 paths gets you there. The second path is the Direct Express card. And this one is important because it exists specifically for the people who do not have a traditional bank account and have never had one. The Direct Express card is a prepaid government-issued debit card. The Social Security Administration loads your benefit directly onto that card every month. You use it like any other debit card anywhere that accepts debit cards. At the grocery store, the pharmacy, the ATM, anywhere. There is no bank account required. There is no credit check. There is no minimum balance. It is designed so that the absence of a bank account is not a barrier to receiving your benefit electronically. To get a Direct Express card, you can call 1-800-333-1795 or go to directexpress.com and request one. The setup process is straightforward, and there is customer service available to walk you through it if needed. The critical point I want you to take away from this first change is that the wrong move, the only truly dangerous move, is to do nothing and assume the paper check will continue to arrive, because that assumption is going to fail. The government has given its timeline. The transition is happening. Setting up electronic payment now, while it is calm and while nothing is broken, is infinitely better than scrambling to figure it out after a payment has failed to arrive and you are on hold with Social Security trying to sort it out. Let me also address the objection I hear most often when people resist making this switch, which is some version of, "I do not trust electronic payment. I want to be able to hold my check in my hand. I have always done it this way." I completely respect where that feeling comes from, but let me give you the factual picture. A paper check is statistically far more likely to be lost, stolen, or delayed than an electronic payment. Mail theft targeting senior benefit checks is a documented and growing crime. I have worked with families where a paper check was stolen from a mailbox, the ink was washed off, and the check was fraudulently cashed by a stranger. And then, an elderly person on a fixed income spent weeks trying to sort out the nightmare of proving to the government that their own money was stolen, waiting for a replacement, managing bills in the meantime. That exact scenario cannot happen with electronic payment. When your money goes directly into your account or onto your Direct Express card, there is no physical piece of paper sitting in a metal box on a public street that anyone can reach into and take. The money is simply there in your account on your payment date. Secure, immediate, not interceptable by anyone. The move to electronic payment is not just a government mandate, it is actually a better and safer arrangement for the people receiving the payments. Now you just need to make it official before the deadline. That is change number one, and if you take only one action from this entire video today, and you or someone you care about is still receiving a paper check, let it be this. Get on direct deposit or the Direct Express card now. Now let us talk about change number two, and this one is not about protecting money you are already receiving. This one is about going and claiming thousands of dollars that are sitting in the tax code right now, with your name effectively on them, that most seniors will never touch because they simply do not know the deduction exists. The second change is a brand new tax deduction that was created specifically for seniors as part of major federal tax legislation passed in 2025. It is sometimes being referred to as the senior bonus deduction, and depending on your specific tax situation, it can shield up to $6,000 of your income from federal taxation per eligible person. Let me put that in perspective. If you are a married couple and both of you are 65 or older, and your combined income falls under the relevant threshold, that is two deductions, $12,000 of your household income that the IRS no longer taxes. For typical retired couples living on Social Security and a moderate amount of retirement income, this translates directly into real money. Over $1,000, sometimes closer to $1,500, either coming back to you as a larger refund or zeroing out a bill you would otherwise have owed. Now let me show you what that actually looks like with two concrete examples, because a deduction can feel abstract until you see the numbers in action. Picture a married couple, both 68 years old. They live on Social Security and a small pension. Their combined income is comfortably under the $150,000 threshold for married couples. Both of them are 65 or older. Both of them qualify for the deduction. So they claim two of these deductions on their joint return, $12,000 total shielded from federal tax. At their effective tax rate, that is real money back in their pocket, money they keep instead of sending to Washington, simply because they knew this deduction existed and made sure their tax return reflected it. Now picture a single woman, 71 years old, living on her Social Security and modest withdrawals from her savings. Her income is well under the $75,000 threshold for single filers. She qualifies for the full $6,000 deduction all by herself, on top of her regular standard deduction, just because she is 65 or older and knows to claim it. Neither of those people did anything complicated. They did not restructure their finances. They did not itemize their deductions. They did not hire a specialist. They simply claimed a deduction they were entitled to on a return they were already filing. Now here is the part that makes this one genuinely accessible, and I want you to really hear it because it removes the most common excuse people give for not pursuing tax breaks. This deduction is what is called an above-the-line deduction. That is a technical term, so let me translate it into plain language. It means you do not have to itemize to claim it. You do not need to collect receipts. You do not need a mortgage interest deduction or large charitable contributions or any of the things people typically associate with getting a meaningful tax break. You can take your normal standard deduction, the simple, straightforward way that most retirees file their taxes every year, and you can still stack this additional $6,000 on top of it. That is about as close to free money as the federal tax code ever produces. It sits there, available. It requires no unusual financial move to access. It just requires knowing it exists and making sure the return reflects it. But here's where I have to give you the critical detail that determines whether you get the full benefit or not, because there is an income threshold, and it matters. The full $6,000 deduction is available to seniors with a modified adjusted gross income up to $75,000 if you are filing as a single person, or up to $150,000 if you are filing as a married couple jointly. Above those levels, the deduction begins to phase out. It shrinks incrementally for every dollar of income above the threshold. And once a single filer reaches $175,000, or a married couple reaches $250,000, the deduction disappears completely. For the vast majority of retirees living on Social Security and a reasonable amount of retirement income, you are under the threshold and you receive the full benefit. But there is a planning trap here that I need to warn you about, specifically because it catches people off guard. The income that counts toward this threshold is not just your Social Security benefit. It includes your retirement account withdrawals, the interest and dividends generated by your savings accounts and investment accounts, any capital gain if you sold a property or investments, and all other income sources combined, everything added together. So if you are planning to take a significant distribution from an IRA this year, or if you are considering selling an asset that will generate a taxable gain, that single transaction can quietly push your total income over the threshold and shrink or entirely eliminate the deduction you were counting on. The lesson here is straightforward. If your income is anywhere near the threshold, think carefully about the timing of large distributions or asset sales before you execute them. Spreading a large IRA withdrawal across 2 calendar years instead of pulling it all in 1 year can be the difference between keeping the full deduction and losing it. Planning done before December 31st is always more powerful than surprise management done in April. One more eligibility detail that matters especially for married seniors. If you are married, you generally need to file your federal taxes jointly to access this deduction. If you file as married filing separately, you are excluded from it. For the overwhelming majority of married couples, filing jointly is already the standard approach. But if there is any reason your household has historically filed separately, this year is a particularly good time to review that with a tax professional. Now, what is the action here? When you file your federal return on Form 1040 or the 1040-SR, which is specifically designed for seniors, this deduction is where it gets claimed. If you use a tax preparer, you look them in the eye and you say specifically, "I am 65 or older. I want to make sure you are claiming the new senior bonus deduction for me, the $6,000 one that came out of the 2025 tax legislation." Do not assume your preparer already knows about it or is automatically applying it. Confirm it explicitly. If you file your own taxes using software, the program will walk you through it based on your age. But do not rush past the age-related questions because that is where the software identifies your eligibility. And here is the move that almost nobody knows about, but that can recover real money from returns that have already been filed. This deduction applies to tax years 2025 through 2028. If you already filed a return for a year you qualified for, and you did not claim this deduction because you did not know it existed, you are not necessarily locked out. You can file an amended return using Form 1040-X to go back, claim the deduction on that prior year return, and receive the difference as a refund from the IRS. Think about what that represents. A married couple, both over 65, who has been filing without this deduction for even 1 year, could recover the equivalent of more than $1,000 by filing a single amended return. And if they missed it for multiple qualifying years, multiply that by each year. That is real money sitting in the IRS system waiting for a form that most people will never file because they never knew the deduction existed in the first place. That is change number 2. Now let us move to the third change, And this one applies to every single person watching today who takes prescription medication through Medicare, because it puts a legal ceiling on a cost that for many seniors used to have no practical ceiling at all. The third change is a cap on what you pay out of pocket for covered prescription drugs under Medicare Part D within a single calendar year. And I want you to understand the full significance of this, because for a long time, the most painful part of the prescription drug benefit for seriously ill seniors was exactly this. There was no real upper limit. If you had a major illness, if you were on an expensive specialty medication, if you had multiple conditions requiring multiple costly prescriptions, you just kept paying, month after month, year after year, with no finish line in sight. The costs could reach levels that forced people to make genuinely terrible choices between medication and rent, between medication and food, between taking the full prescribed dose and stretching prescriptions by taking half doses to make the bottle last longer. That is the specific nightmare this change was designed to end. Here is the number. Federal law established a $2,000 cap on annual out-of-pocket drug spending under Medicare Part D beginning in 2025. And because the law includes an inflation adjustment mechanism, for 2026, that cap is $2,100. That is the ceiling, the hard stop. Once your out-of-pocket spending on covered Part D medications adds up to $2,100 in the 2026 calendar year, you are finished paying for the rest of that year. Your plan covers 100% of the cost of your covered drugs from that point forward through December 31st. Not a reduced copay, not a lower coinsurance percentage, nothing. $0 out of your pocket for covered prescriptions for the remainder of the year once you hit the cap. For a senior on a specialty medication that costs several $100s per fill, this is transformative. In the old structure, that person paid that cost every single month all year with no relief coming. Under the current structure, they pay as they go at the start of the year, and their spending climbs toward $2,100. For many seriously ill seniors taking expensive medications, that ceiling gets hit sometime in the spring, and from the moment it is reached, every covered prescription from spring straight through December costs them nothing at the pharmacy counter. Let me walk you through what this looks like across a real year, because the timing dimension of it is what surprises people most favorably when they actually see it play out. Imagine you take a specialty medication that runs you $400 per monthly fill. In January, you pay $400. In February, you pay $400. In March, you reach somewhere around the $1,200 mark out of pocket for the year. By the time May arrives, you have hit or are very close to the $2,100 annual ceiling. And from that moment, every covered prescription you fill from May through December costs you nothing at the pharmacy. 8 months of covered medication at $0 out of pocket, against a year where previously you would have paid $400 every single month without any ceiling stopping the meter. For families that were rationing medication, splitting pills, delaying refills because the monthly cost was impossible to manage consistently, this change means they can actually take what their doctor prescribed at the right dose at the right time without a financial calculation interfering with a medical decision. That is the real-world impact of this cap. Now let me make sure you understand what counts toward the cap, because this is where confusion typically arises, and I want to be precise with you. The $2,100 ceiling applies to what you actually pay out of your own pocket for your covered drugs. That includes your annual deductible, it includes your co-payments, it includes your coinsurance amounts. All of it accumulates toward that ceiling every time you pick up a covered prescription. What does not count toward the cap is your monthly Part D premium, the amount you pay simply to have the plan. That premium keeps going regardless of where you are relative to the cap, but every single dollar you hand the pharmacist for a covered medication is a dollar counting toward that $2,100 ceiling. Once the meter reaches $2,100, it stops for the year. Now here is the action that turns this from a useful piece of information into actual money savings, and it is especially critical if your income is at all limited. There is a federal program administered through Social Security called Extra Help, sometimes referred to as the Low Income Subsidy. Extra Help is specifically designed for Medicare beneficiaries with limited income and resources. And what it can do is dramatically lower what you pay for Part D before you even reach the annual cap. It can reduce your premium. It can eliminate or drastically lower your deductible. It can drop your co-payments to almost nothing for both generic and brand name medications. For a senior who qualifies for extra help, the economics of prescription drug coverage look completely different. Instead of paying full copays until you hit the cap, you are paying near zero copays from the very beginning of the year. The protection is front-loaded rather than back-loaded. You do not have to spend your way to $2,100 to get relief. The relief starts from your very first prescription of the year. And here is the critical fact that I see trip people up constantly. A large number of seniors who qualify for extra help never apply because they assume they make too much to qualify. They dismiss it without ever actually checking, and that assumption costs them real money every single year. The income and asset limits for extra help are more generous than most people assume. They have also been expanded in recent years, which means people who were turned away or who decided not to apply in the past based on outdated information may now qualify. The only way to know with certainty whether you qualify is to apply and let Social Security run your actual numbers against the current eligibility criteria. The application process is not complicated. You can apply for extra help online through the Social Security Administration website. You can call Social Security at 1-800-772-1213 and apply over the phone. Or you can go into your local Social Security office and do it in person. The form number is SSA-1020. The application is free. It does not obligate you to anything, and if Social Security determines you qualify, the savings can run into the thousands of dollars annually. There's also a shortcut worth knowing about. If you already receive Medicaid, if you receive Supplemental Security Income, known as SSI, or if you were enrolled in a Medicare savings program through your state, you may already automatically qualify for extra help without needing to file a separate application. It is worth verifying your current enrollment status directly with Social Security to confirm whether extra help has already been applied to your coverage. For anyone taking regular prescription medications under Medicare Part D who has not recently confirmed whether they qualify for extra help, I want to be direct with you. Making that one inquiry is one of the highest return actions you can take this year in terms of dollars saved relative to time invested. One phone call to Social Security, one online application, potentially thousands of dollars in annual savings on medications you are already taking and are going to continue taking regardless. The cap protects you from catastrophic annual costs at the high end. Extra help protects you from excessive costs at every individual prescription throughout the year. Together, they represent the most significant restructuring of out-of-pocket drug cost protection for seniors in decades. And most people who qualify for and would benefit from both do not know either one exists. Now let me bring all three of these changes together, because I want to make sure you walk away from this video with 3 clear actions, not 3 interesting facts that fade by tomorrow. The first change is about your payment delivery. Paper Social Security checks are being eliminated by federal mandate. The transition is in progress now. If you or anyone you care about is still receiving a paper check, the action is to set up direct deposit into a bank account or request a Direct Express card before that paper check stops. Do not wait until a payment fails to arrive to address this. Do that today. The second change is about your taxes. A new senior bonus deduction of up to $6,000 per eligible person exists for tax years 2025 through 2028. The income thresholds are $75,000 for single filers and $150,000 for married couples filing jointly. The action is to make sure this deduction is being claimed on your current and future federal returns. Confirm it with your preparer explicitly. And if you already filed a qualifying return without it, file an amended return to recover the money. The third change is about your prescriptions. Your annual out-of-pocket cost for covered Medicare Part D drugs is now capped at $2,100 for 2026. Once you hit that ceiling, covered drugs cost you nothing for the rest of the year. And if your income is limited, applying for extra help through Social Security can dramatically lower your costs well before you ever reach that ceiling. The action is to verify whether you qualify for extra help and apply if you do. 3 changes: your deposit, your refund, your prescriptions. The seniors who hear about these changes today and act on them this week are in a fundamentally different financial position from the seniors who hear about them and think they will deal with it later. Later is how deadlines pass. Later is how unclaimed deductions stay unclaimed. Later is how prescription assistance programs sit unfunded because the application was never submitted. I want you to be in the group that acts. Not because anything I have told you today is complicated, none of it is, but because knowing is only half of it. The doing is the other half, and the doing is what changes the number in your account. This is general education and not specific legal or financial advice tailored to your individual circumstances. So confirm your specific situation with Social Security, with the IRS, or with a qualified advisor before you take action. But do not let that caveat become a reason to delay, because the people who use every caveat as permission to wait are consistently the ones who miss deadlines and leave money behind. If this video gave you something useful today, share it with one person over 60 who needs to hear it. There is a better than average chance that nobody has ever told them any of this, and for some of them, what you share could be the thing that keeps their payment arriving reliably, puts real money back in their hands at tax time, and makes their medication affordable for the rest of the year. Subscribe and turn on notifications so you do not miss the next one, because these changes keep coming, and the seniors who stay ahead of them are the ones who keep more of what they have worked their entire lives to earn.